to this for yourself, or maybe you've worked with clients that have, or maybe family friends. When it comes to an estate situation, perhaps the kids start fighting, and that's not really a positive outcome. They may want to avoid talking about how they want their assets split between their beneficiaries, because fair might not always mean equal. And that might be the situation where child A is excellent with his or her finances, child B, maybe not so much. So, and then they'd rather have their family or their estate receive their money than have it go into taxes. So, with the growing population, dementia is having a significant and growing impact across the country. Uh, I'm happy that this slide is on here. You don't really have to look too far. You don't really have to listen too far. I think this is becoming more and more of a prevalent topic, and this really does highlight the urgency that we need to have with clients in this age range to get contracts set up before mental incapacity happens. Now, dementia refers to a set of symptoms and signs associated with a progressive deterioration of cognitive functions that affect daily activities. That's a mouthful. Now, I'm sure everybody's heard of Alzheimer's disease. That's the most common cause of dementia. But symptoms include short term memory loss, long term memory loss, as well as a person's ability to communicate may become impaired. For some people, they may only struggle with specific financial decisions. Often, people with dementia, they can continue with their day to day activities, such as paying for their shopping, or maybe they go to the mall and buy, a great sweater. But they do have difficulty with some complex decisions. So, for example, they may struggle with changing who their gas supplier is or who their internet supplier is, or the key decisions when it comes to their investments. So we know that everybody on this call today cares about their clients' lives, and watching somebody struggle with dementia is a challenging and very difficult thing to go through. I know I've done it, and it's not a great thing to watch. So if your client does have a power of attorney, that individual can set up a segregated fund policy. But I do want to make a note that those individuals are not able to name beneficiaries. This is done to protect vulnerable persons from abuse. So, to ensure that no new and unwanted beneficiaries are added by a dishonest power of attorney, the estate in this situation must be named as beneficiary. I do want to make a side note here that I have seen instances in the past where Canada Life does grandfather named beneficiaries. So, situation is if we are moving a current policy from a different supplier to Canada Life, we will grandfather the beneficiaries on the policy at the other supplier. So, I do want to make a note of that so everybody is aware of that. Now, recently, the Canadian Securities Administrators introduced a requirement for financial advisors to provide more oversight for seniors and investors with diminished mental capacity. This is a really good thing. This highlights important issues for retirees, people with aging parents, or other at risk family members, and the financial industry. This includes the introduction of a trusted contact person, as well as the introduction of temporary holds on transactions. So, the trusted contact person provision requires advisors to try to obtain contact information for a family member, a friend, or other trusted party to alert if there's concerns about an investor's ability to make financial decisions or exploitation. Not a good thing. The temporary hold provision permits advisors to delay a transfer or a withdrawal from an investment product if there's the same concerns. So, when speaking with these clients, it's important to keep in mind that mental capacity is a key concern for this client group. We want to make sure our clients understand the financial advice that's presented to them. So, according to a recent Angus Reid survey, 51% of people never get around to writing a will, and they're not aware of the consequences of dying without one. That's huge. When I saw 51%, I was blown away by that. I think this is where we can start to think about our block of business. And, does this client, have I talked about estate planning with this set of clients, with this set of clients? 51% is a massive number. I think this is where we can become very competitive in asset aggregation if we don't have all of our clients' assets. And maybe advisor B hasn't talked to the client about estate planning. Super, super key. Without a will and a proper estate plan, clients can lose control over who and how their assets are distributed at death. Not good. Although your clients may assume the immediate family is going to be in charge of their assets after they die, many factors may mean that's not going to be the case. If the family can't agree on an estate administrator, the courts are going to appoint one. This process is often more complex than if there was a will in place and can add time and costs to the settlement process. Since an estate includes debts, your client's family could be left to manage debts while the estate assets are frozen. With probate costs at an all time high, by not estate planning and using products and strategies that could have saved fees and taxes, beneficiaries may receive less than if planning was put into place. So, not having a will means that your clients will have no say with what happens with their assets after they pass away. So this is an interesting slide. It talks about family conflict and family conflict. So a recent survey of attendees at the 53rd annual Heckerling Institute on Estate Planning identified family conflict and the top causes of family conflict. So attendees at this conference included attorneys, trust officers, accountants, wealth professionals, charitable giving professionals. So individuals from all over. And the top causes of family conflict that were identified were beneficiary designations, absence of communication, and dynamics of blended families. That's a big one. It's also interesting to note that coming out of this, 32% of affluent families were worried about how their heirs would manage their inherited assets. And 36%, so over a third, claimed that their children lacked the financial literacy to appropriately manage such a windfall. Everybody on this call can help here. Help clients navigate their estate planning or help clients that are likely to become executors with financial expertise and support that they need. Help them through that process. Help eliminate stress for your client's family, which is huge. So, here's how much money is going to be at play and is at play. $1 trillion. Like, that's so much money. It's so hard to wrap your head around, right? But here's those buzzwords again: intergenerational wealth transfer. It's been happening for several years and it's going to keep happening going forward. Such an opportunity for everybody on the call today. From 2020 to 2030, $1.2 trillion dollars in assets will be transferred between households. It's going to be the largest transfer of wealth in Canadian history. We're right in the middle of it. So of the 1.2 trillion, 840 billion is going to be in financial assets like deposit products, investment funds, individual securities. 418 billion will be in real estate assets, with most in residential real estate. I don't think I need to suggest like this is a massive aggregation opportunity. You can be proactive, talking about estate planning with your clients to have a chance to aggregate further assets to your block of business. So, who's going to inherit? And this slide takes a bit of a look at that. So the biggest benefactor of this intergenerational wealth transfer will be Generation X. So those individuals born between 65 and 80, they're going to inherit roughly 450 billion of the financial wealth that's available. Also growing significantly is the millennial cohort. So these households are primarily recipients of early inheritances from the baby boomers, and they're set to receive slightly less than Gen X. The young baby boomers are also involved as well. So those individuals born between 55 and 64, they're going to be running into about 252 billion from estates to inheritors over the age of 65. Much of the baby boomer and Gen X wealth has or will be transferred from 2016 to 2026. So the good news is there's still wealth at play for several years to come. That's not to say millennials won't hold any wealth, but looking at the numbers, it's going to be the baby boomers and the Gen Xers who are the major players. So I think the key point here is no matter the generation, There needs to be some important financial conversations in many families. As an advisor, you're already positioned to build those bridges between the generations. As you educate families on estate planning, they're going to see how they can define their legacy with generations of their family, and they're going to want to work with you as their primary advisor. So, inheritance is in motion. And I'm going to pose the question, and it's a fairly easy one to answer. What do we think happens when families don't talk about their estates? And then something unexpected happens. Maybe one of the spouse passes away unexpectedly. Well, in many cases, the inheritors are going to leave the initial advisor. Clients often leave their advisor after their spouse passes away. This shows the need to connect with both spouses, not just the one who handles the finances. Many inheritors don't feel a connection with their parents' advisor, and they're going to leave after their parents have passed away. This means when your clients die, so do those assets off your block of business. Not a great outcome. If you're proactive in strengthening those connections, including the family in the conversation, you can demonstrate your value to the family before the wealth transfer ever happens, and you increase the percentages to keep those assets. Couple suggestions. The first, and I've already mentioned it, and it's the easiest to do, connect with both spouses. Make sure you direct information at both of them, not just the husband, not just the wife, but both spouses. If one person passes away first, then you're going to have a better chance of keeping the assets under your block of business. Secondly, engage in those family conversations. Engage with everybody who's a part of that inheritance process. You can put together a holistic financial plan that's going to move across the generations and put a fence around those family assets. So, understanding the role of the executor, and I think most everybody on the meeting today will know who an executor is. But the reality is, the transfer of wealth has family implications, and you're going to be talking to clients in your 50s and 60s with elderly parents. One of the most important parts of writing a will is identifying that executor. So, that executor of a will is somebody that's nominated to carry out the wishes left in a will. It could be family member, it could be friend, it could be a professional. I think a lot of time what happens is it is the client's adult child or children. So, what concerns may the designated executors have? And no matter the age, I think it's reality. Most parents want to take care of their children and not be a burden. This should be done even after death. So, not just while they're living, but after they pass away. Estate planning is important to not leave your children with the stress of potential court battles, delays of having to probate the will, or potentially not receiving the assets that you intended them to have. Without a plan, they may be left trying to deal with the estate during an incredibly stressful time. Now we can see on the slide here a few of the concerns. Being unsure of what the responsibilities will include. You know, it's true if you've never been an executor before, you probably have some questions about what it's all about and what you're going to do. Not being comfortable talking to your parents about their death. I can speak personally. My dad is elderly, and it's not a great conversation to have, but it's certainly one that we need to have with our elderly parents. Hearing horror stories about being an executor. So maybe a friend down the street has been one and it was a terrible experience. I don't want to be one ever again. You know, that is a concern. Wanting to make sure that the elderly parents don't get taken advantage of. That's a very important one. And then lastly, not wanting to do something that's going to lose mom or dad money over time. So, unfortunately, being an executive of a will, it can be difficult and it can also be time consuming. So, some things an executor needs to know. In some provincial jurisdictions, the estate administration process can be done in two stages, which could cause delays. For example, Ontario, financial assets are dealt with first, and then hard assets are dealt with second. Also in Ontario, the executor is responsible for keeping the records of the estate for over the next 4 years after the estate information return, simply because CRA can review it and reassess it. That's a lot of responsibility, right? Beyond financial duties, so there's duties about, does the executor have access to passwords to all the online accounts of the individual who passed away? How quickly can these be accessed? Could there be issues around closing down social media accounts or email accounts? Estates can take over a year to complete, but your expert financial advice can make things easier and bring some solutions to the conversation. So, I'm going to shift gears now and we're going to dive into our Canada Life Estate Protection Series product strategy. And I love it. Um, you've helped your clients through their financial planning, various stages of their lives. With our estate protection series, you can continue to support your clients as you help them secure their legacy. Our estate protection series segregated fund policy can help clients pass on their legacy to their beneficiaries securely with built in guarantees. It also provides potential for growth and flexibility for your client's investment portfolio. Now, we do have excellent marketing materials. I'm giving a shout out to our marketing department right now. We've superb marketing materials around our estate protection series policy, advisor guide, product guide, client guide. If you are looking for some support pieces, certainly reach out to your aligned wholesaling team and they can get that to you in short order. So, here's a great summary slide about our estate protection series policy. And it's meant for clients age 80 to age 91. Automatic 100% death benefit from day one of the policy opening. I love this because before I became Canada Life wholesaler, I was a credit union advisor, and I dealt with a lot of GIC credit union members. And I know this is easy conversation to have with clients in this 80 to 91 age range. They're looking for something guaranteed. Well, bam, 100% death benefit from day one. Well, they want something that they can set up for their intended beneficiaries. Well, bam, here it is, a state protection series. 100% death benefit from day one, sold as front end zero only. Low charge. So that is a key point. There's no chargeback and there's no DSC available for our state protection series. We do offer this in traditional embedded pricing, which is our estate protection standard series. And we also offer it in a fee based series option, which is called estate protection partner series. I do want to make a note. It's important to be aware our estate protection series is sold using a different application as well as a different information folder than our regular segregated fund platform. So the available funds for our state protection series platform include a selection of our target risk asset allocation funds, as well as a few of our individual balanced funds, fixed income, as well as our money market fund. But what does this mean for your clients? Well, they can know upfront that all their invested money will be passed on to a loved one or a charity that they support. There's opportunity to grow their money as they invest in something from conservative up to balanced investing space while guaranteeing a minimum that's going to be passed on to their intended beneficiaries. I do want to make a note that for joint annuitants, the youngest annuitant must be at least age 80 and not yet age 91. I do want to highlight here. I know in my aligned territory, I've seen several wins in this exact scenario. So we have two spouses. One spouses call it age 92. The other spouses call it age 88. We can open up an estate protection series contract based on the age 88-year-old. It's awesome, and it's a really easy conversation to have with those clients. So our solution can help clients structure their estate so it can be transferred to the next generation easily and in a tax efficient manner. So circling back to the joint annuitants feature, highlighting the fact that clients can have greater control over their estate planning. It allows more decisions to be made upfront without having to worry about who passes away first, with no further signatures being required. Decisions can be made when both annuitants are well, and mentally confident in their decision making. Non registered policies only can be set up with joint annuitants, and it's applicable for spouses as well as common law. So, customized inheritance. This is an awesome feature too. Different options for different beneficiaries on different schedules with only one account. The estate protection plan provides clients control over how they want their money to flow after they pass away. Your clients can decide how they want each beneficiary to receive their inheritance. They can choose between any combinations of the assets distributed at death for each beneficiary. It could be lump sum, it could be monthly income for life, it could be monthly income for a set number of years, it could be a combination for all three options. So you could have children, say three children, and we could choose lump sum for child A, maybe monthly income for life for B, child B, and maybe monthly income for a set number of periods for child C. Super flexible. And this is done through the settlement option form, which is available for non registered policies only. This can be done without having to set up a testamentary trust and a will. Super key. It means your clients can avoid additional legal expenses because we don't want those to set up this arrangement and can easily change the payout structure if needed. The estate protection plan also allows your clients to avoid ongoing maintenance, which is required with a trust, to ensure that the assets of the trust are being managed and distributed, as well as tax returns being filed for the trust. That's a lot. So planning up front with the settlement option form can save on these costs, and instructions can be changed down the road with a newly submitted form without having to pay. Super easy to do. So just like all of our segregated fund products, our estate protection series plan does allow your client access to their funds. It's very flexible. Obviously, it's due to being a front end load zero product only. So your clients can use their money if they need it for things like unexpected expenses, maybe extended care home costs or in-home care costs. Maybe they need to pay for their grandchildren's education, or they want to make a lump sum payment on their own children's mortgage balance. Your clients can also grow the policy by adding money to that policy at any time up until the younger annuitant turns age 91, still 100% death benefit guarantee. Now, the guarantees, of course, are reduced proportionally by any redemptions that are made. So, with a 100% death benefit guarantee, your clients are going to know the minimum amount that's going to be passed on. The 100% death benefit guarantee means your clients will meet their goal of preserving their capital, and they can be confident that the amount of their original investment will be passed on to their named beneficiaries. Canada Life is one of the few companies that offers this 100% death benefit between ages 80 to 91. And we are the only company that is playing in this space up to the client turns age 91. And I have heard it from trusted sources. We're not going anywhere from this because this product resonates so well in the industry. If you haven't heard about it, or if you haven't paid attention to it, if you haven't had a client conversation and maybe tried to recommend this, do it, because it's such a good product for our clients out there. So no matter what happens in the markets, the money that your client puts in, it's not going to be lost. It goes to their intended beneficiary. And here's a slide that alludes to it. So, guess what? Markets can be volatile. I think the past few weeks in the markets, we don't have to look very far. And maybe the first word that comes to mind is volatility. So we're going through it right now. During those times, mutual fund values, they do drop. And this slide alludes to it. With our Canada Life Estate Protection Series, the fund policies have the 100% death benefit. So the beneficiaries are going to receive the amount that was invested minus any withdrawals that were made, even if markets dipped at the time of death. So even if timing dictates that the policy value is down versus a mutual fund account where that's not the case. So a huge win with our estate protection series product there. It's true that Age 80 to 90-year-old clients, they've worked hard to earn their money over the years, and they want to make sure that their savings are secure. I think that's their number one goal, right? They're not looking for rates of return 8 to 10%. They're looking for something that's secure. Clients have to take on greater risk to achieve the same returns. It's not just clients in this age range, it's clients across the board. It could be ETFs, it could be alternative exposure. So often more susceptible to market events when we're doing this. Encouraging clients to stay invested to take advantage of market recoveries, that can be a difficult conversation, not only with clients in this age range, but any age range. However, lessons of history have taught us that we need to stay invested in order to take advantage of that market recovery. But guess what? Market crashes can have a great impact, not only on an investor's accumulated savings, but also on their mindset. So that's where we can position something that's 100% death benefit guaranteed that we don't need to worry about having that conversation with our clients about. So here is a slide highlighting the different fund options on our estate protection series platform. A curated offering. At Canada Life, it's true. We are committed to managing and improving our fund offering so that we're offering our clients investment solutions that are relevant, competitive, and positioned to win, and will meet their unique needs for life as they know it. Your clients get to choose on our estate protection series platform from our asset allocation funds or some excellent standalone funds with a range of mandates available from conservative investing space up to balanced investing space. I work with a lot of advisors in my territory that use just conservative allocation for their estate protection series client recommendations, and they're loved by their clients, not because they're trying to get great rates of return, but it's more about the strategy. That's why they're loved by their clients. So our curated offering is to accommodate the target market of the product with more conservative expectations of your elderly clients. I do want to make a side note here that our GIO product, so our guaranteed interest option product, it's not available on our new estate protection series contract. We have balanced funds, we have fixed income funds, we have asset allocation funds, conservative, moderate, balanced asset allocation. We do have three of our better balanced funds of our regular platform available on our estate protection series platform. So our balanced fund that's managed by TD Greystone, that's such a great fund that resonates really well with clients and advisors on our platform here. Our balanced fund that's managed by Boutel Goodman is available on our estate protection series shelf, and so is our balanced fund that's managed by Invesco. So those may be a few to take a look at and perhaps think about mixing into client conversations or recommendations in the future. This is a slide that I love because I think this slide has been around for a long, long time. It just the investment changes, but it's always the same topic. So something investment versus a GIC, and with our moderate allocation fund, it's done very well versus GICs over the past number of years. But I think it's true. Clients in the age 80 to 90-year-old range, they've been well served by GICs over time. They went through the 1 year for, I don't know, 12% or 1 year for 5% not that long ago. And because of that, their mindset is anything in the equity markets is a wild ride. So it's kind of an uphill battle when you're dealing with clients that have that headspace. Our moderate allocation fund, it's outperformed GICs over the past decade. It's only had one calendar year of negative returns, and that was during the 2008 financial crisis. Simple yet sophisticated solution that appears as one line on the client's statement, so it's not going to overwhelm your client at all. It's a managed portfolio with a diversified by asset class and management style, target weight of 60% fixed income, 40% equity, constantly monitored and rebalanced to stay on that risk profile. From a compensation perspective, this fund, although it's overweight fixed income, it does pay a 100 basis point trailer. That's gross. So that provides ongoing cash flow versus a GIC sale would. Now, segregated funds typically have higher fees than mutual funds, but they do offer powerful features complementary to estate planning. You may have assumed that there's going to be an additional cost or rider with our estate protection series funds because of the increased risk that age factors into the offering. However, our estate protection series funds are priced exactly the same as our 75 100 guarantee segregated funds. This means there's no added cost for a premium product for your clients in that age 80 to 91 life stage. And we're the only company that goes up to age 91. I'm going to emphasize that again. I do want to make a note, though. It's important to be aware that our estate protection series platform does not offer high net worth pricing. So, our preferred series one or our preferred series two or our preferred partner series are not options on our estate protection platform. Rationale for fund shelf selection and pricing. So for estate protection series, there's no graded death benefit schedule. Premiums added from age 80 up till age 91, they do get that 100% death benefit guarantee right away. So that's great. When comparing the average client holding of normal segregated funds to an estate protection series client in the age 80 to 90 age range, there's a higher chance of death, of course, in the first 5 years, approximately 10 times that of a 55-year-old client, which means there's a richer guarantee and has a larger cost. So, to maintain consistent fees and not charge a premium for our estate protection series product, we chose a group of funds to potentially reduce the pressure to increase the fees. This generally means less risky funds. So we do have nothing above balanced investing space, no equity mandates on our estate protection series platform. So that will lessen, but it doesn't eliminate the higher expected cost of the guarantees associated with our estate protection series product. So we've talked about the ability to name beneficiaries on our non-registered segregated fund policies, and assets passing outside of the estate is a powerful feature. And in our experience, clients age 80 to 90, they do typically have a higher proportion of non-registered assets. Potential costs on this slide, I won't go through them, but guess what? It's more than just estate costs. There's executor fees, there's maybe accountant fees, whatever the fees are. So it could be the slide here alludes to 4.75% up to 12.5%. It depends on the province. It depends on the situation um, that our clients are going through. Segregated funds can save estate administration fees, though, speed up the settlement process for investments, and offer protection from market volatility. But how much more will your client pay? Well, guess what? It might be less than you might think. And the difference for a balance mandate to a fixed income mandate, it might surprise you. It's right there on that slide. So for a fixed income fund, comparing our Canadian core mutual fund MER, it's 38 basis points difference up to our 75 100 segregated fund version. That's not a lot. Our balanced folio, comparing the mutual fund folio versus the balanced segregated asset allocation mandate, it's 39 basis points difference. So you might think that it's a massive, massive difference for your clients to pay. It really isn't. And you do get value. You get a lot of value, like I've already mentioned. So if we used a very conservative assumption of 4.72% as the estate settlement savings with segregated funds, at what point would the additional cost of the MER eliminate the benefit of segregated fund estate bypass? So years to break even. This alludes to balanced fund example. So if we did use a very conservative assumption of 4.72% as the estate settlement savings with segregated funds, at what point would it break even? So for the Canada Life Balanced Allocation Fund, despite the segregated funds, the MER costs 37 basis points more than the mutual fund. It would take the mutual fund 15 years to cover the probate fees of 4.72%. In other words, to make it worthwhile to invest in mutual funds, It would have to be 15 plus years. That's a long time. When we did the analysis for a bond fund, it turned out to be 17 years for the mutual fund to break even. That was using a growth rate of 3% and a difference of 33 basis points on the MER. So a bit of a case study there. I do like this slide because it's so easy to understand for clients. It's, hey, on the left, here we have potential costs that we'd have to go through if we're doing probate, versus the right. Guess what? We don't have those costs. And here is the 1.5 million at minimum that your client would be able to pass on to their intended beneficiaries. Um, with mutual funds, the executor might need multiple meetings with their accountant, lawyer, financial institution where the assets were held. That means taking time out of their busy schedule. So there's a lot to do. It could be probate fees, it could be fees for the legal and accounting for the executor. So they add up, right? With the estate protection series on the right, we're not going through that. So that's why it's a much better option than potentially going with a mutual fund recommendation. This is the right thing for the client, right? What happens if markets drop? Well, guess what? Sometimes timing dictates that client passes away and values have dipped. I'm sure that's happening right now with our clients. So that decreases the value even more. So this is such a great conversation to have, even with clients that are nervous to be invested in the markets, simply because of that 100% death benefit guarantee. Years to break even. There is an additional cost. Let's run the numbers. How many years it takes to break even? Again, I'll allude to the balanced allocation. Despite being segregated funds, uh, more to pay. We are breaking even the 15-year and then the 17-year with the fixed income fund. So resources available to support you. I'm going to skip this slide and I'm going to throw this slide up because I know we're running up against time here. Um, I think the key point here is lots of resources available. Um, Shout out to our marketing department. Fantastic. Your aligned wealth wholesaling team would be more than happy to help. The estate protection series, it's such an easy conversation with clients. I've seen so many wins with advisors, and they're so thankful to us. But you know what? The solution is doing right by their client. And that's awesome. Like that's what we're supposed to be doing is let's do the right thing for our clients. So if you're looking for support pieces, if you have maybe a client case that you want to talk through with your respective wholesaling team, please reach out. So the last thing I'll wrap up here, we do want to thank everybody for their business on today's meeting. We know that there's many suppliers out there in the marketplace, and at Canada Life, we're very thankful for everybody on this call, for the business that you send our way, for thinking of us when you have an investment case. Um, Lots of different choices out there. So thank you very much for the business that you've sent our way, and hopefully we'll continue to do so going forward. So that's it for me, and I'll call back Jim here, and I'm happy to take any questions that have come up during the session. Thank you.
Great, Clarke. Let me start by thanking you for your presentation. It was terrific. Lots of excellent ideas, both on the intergenerational wealth transfer that's upon us, and will continue to be an opportunity for us to help our clients, but also to really dig deep into our estate protection product pricing options and the differences between an insured instrument like a seg fund versus a non-insured one. So thank you very much for taking us through that. We've got some good questions lined up here for you. So the first one from Jen. I know some carriers are exiting the death benefit guarantee space. What is Canada Life's position on this? And you may have touched on that, but I'll take an opportunity to repeat.
For sure. Thank you for the question. I mean, I'll preface this by saying I'm not a decision maker at Canada Life. Maybe one day I will be, but our wholesaling team, we haven't heard about anything. I know, other carriers, as mentioned here, have exited that space. We haven't heard of anything, any talk of it at Canada Life. I can't stress enough the traction that our estate protection series product has in the industry. I can't stress enough how many advisors have reached out to me, over the past even 3, 4 months that, hey, Clarke, I came across this. I didn't know that Canada Life offered it. I talked with some of my elderly clients and they love it. So, I can just speak to the traction, the resonation with clients that I hear about from advisors and the cases that are brought our way. Um, I hope that we're not going anywhere. I think that we do want to be a player in this space. I hope I'm not speaking out of turn here. It is a great asset aggregator for Canada Life, as well as for everybody on the call as an advisor. So, yeah, like I said, I'm not a decision maker. That's kind of what I know about that. And I hope we do stay in this space for years to come because it's such a great conversation, especially for the clients age 80 to 91.
Thanks for that, Clark. I might also add, just based on my information, that we are very committed to this product line, this product offering, these kinds of death benefit guarantees. You're right that things can change down the road, but at the moment, our commitment is very strong to this strategy and to this product offering. So it is a good opportunity, as you stated. Next question from Leo, and I think I understand the question, although maybe I'll let you interpret it as well, Clark. Can you speak to the tax treatment of the top if the fund changes?
The tax treatment. So, I mean, I'm hesitant to speak out of turn here as I'm not an accountant. So that might be my best response. If the fund changes, are we talking about maybe if the client passes away and the market is down? I mean, I can speak to Canada Life does bump that back up to the initial investment amount, but anything tax question I get asked, I do sort of hesitate to say anything specific because I don't want to be held liable, and it's best to talk to an accountant. So I'm sorry to side dodge that question, but that's what I'll go with for now.
Yeah, and I think if Leo's question was phrased at time of death, I think it would be easier to answer that, being that there is no, the tax treatment is
Hmm.
far different than if it was withdrawn during lifetime. But I agree with your the way you've answered that, Clark. Next question from Anonymous. I've read the Canada Life Seg Fund contract, and it seems you're the only company that does joint annuitants. Is joint annuitant an option on the estate protection?
Yes. Yeah, I did allude to that during the session, and it especially works well. Again, I'll highlight you have one client that's 91 or over, and then you do have one client that's not yet 91. So that's where I've seen a lot of wins. I've seen I've seen even kind of age 94 client, age 89 client. I've seen, hey Clarke, my client turns 91 in 3 days. I got to get this done. So it is the answer to the question is yes, but I'll further stress, and we did touch upon dementia. Maybe think about your block of business. Do we have clients that are in that age range? Are they mentally capable of decisions? Because it does become a tough conversation. And I've had it with advisors where the client is not mentally capable. And now we're in the situation of the power of attorney opening up the policy and not being able to name beneficiaries, which is a disappointment. But I've had that conversation with several advisors, and it's a tough one. So again, we got to get this done while clients are mentally capable of signing and understand what they're signing. So a bit offside there, but I want to highlight that again.
Great, good call out, Clark. Thank you. The next question is, how do I obtain a hard copy of the marketing materials? Do I reach out to my MGA or contact Canada Life head office directly? Is there a cost?
Um, I would answer that by your wealth wholesaling team should be your first point of contact. If you don't know who that is, you can certainly call our client services, and those individuals could give you the contact information for your wealth wholesaling team. Because we want to work with the advisors, we want to provide the marketing material, have a conversation with advisors. Maybe, hey, I got a client meeting next week. Okay, well, do you want to talk about how you're going to position the estate protection series policy? Maybe do you need backup in the meeting? I've done that lots as well. So um, I think always the wealth support team should be the initial point of contact. If you don't know who that is, certainly reach out to client services and they can let you know.
Yeah, I might also add, Clark, to your comment that most of our marketing materials at Canada Life are available through your wealth wholesaler, as you mentioned. They can be had in both hard copy as well as PDF and electronic copies. Generally speaking, there is no cost for either of those unless you're looking for 500 pieces of a particular item. But yeah, your wealth wholesaler with Canada Life is the very best place to go for the hard or soft copy of marketing materials. Next question from Andy. Seniors favor GICs for safety. Is that as good as dead money without any growth? What phrases do you suggest for open in estate protection chat?
Andy, putting me on the spot here for phrases. So, yeah, I mean, 100% death benefit guarantee is a great one to start with. So, hey, it's the same thing as a GIC. Maybe that slide that we did walk through versus our moderate asset allocation mandate is a good one for show and tell. Here we have something that is guaranteed just like a GIC, but you have the potential to grow it a little more than what a GIC has done throughout the years. I think that GIC clients, they're conservative by nature, but stressing that our estate protection series, it's the same guarantee and the underlying investments are not risky. Like, hey, we don't even need to use a balanced fund. We can use a conservative allocation fund that's highly diversified, always rebalances to the client's risk level. It's not going to blow up on you. That might be a buzzword to use. In market crashes, you can show and tell the Mackenzie Income Fund. That mandate is on our estate protection series platform. And guess what? In 2008, that mandate lost less than 4%. So I think that the slide, it did speak very well to GIC refugees thinking that markets are risky and you're always going to lose money. You got to stress the downside protection with these investments on our estate protection series platform. Certainly not balanced, maybe not moderate, but conservative could be an option. And I have seen, and I know we're right up against time. I've seen the scenario where the clients and their beneficiaries, they work together. Maybe mom and dad, they're not going to need the money for the rest of their lives. So maybe we can get into a different investment space than just conservative. But that would be the approach I would take. Stress the guarantee; it's the same as a GIC. Maybe do some show and tell as to how something that's conservatively invested has performed over the years. And then really harp on it's the estate planning. It's the, hey, you're not going to pay money out this way, out this way, out this way. All the money that's intended for the beneficiaries will go to them, versus trying to sell them on a growth rate. So that might be how I might position it. If that's the last question, thank you very much.
Yeah, Clark, we do need to end things there. For anybody whose questions did not get answered, we will certainly try to do that privately with you over the next couple of days. But once again, your option is also to reach out to your aligned Canada Life wholesaler for the answers to those questions and any others that may have come up as a result of today. So, Clark, I want to thank you very much again for your investment of time with us. Excellent presentation. Really took some good things away from that, and hopefully everybody listening in as well did also. and appreciate your time today, Clarke. So thank you.
Thanks, Jim.
And with that, ladies and gentlemen, we are drawing our Canada Life Day to a close. On behalf of everyone on this call, I want to thank you and, of course, all of our presenters for attending our session today. We enjoyed putting this on. We hope you enjoyed it as well. And we look forward to continuing to host valuable sessions like this one for our advisor audience. All resource materials that you saw today and presentations are available. If you are a contracted Canada Life advisor, it is available through RepNet until such time as we move over to Workspace. But if you have misplaced your RepNet login or having trouble logging in, please email us at distribution.methodology@canadalife.com. And again, feel free to reach out to your MGA or any of your aligned wholesalers for added insight on information that we shared with you today. Just a quick reminder that back in the lobby where you started all of your sessions today is a quick survey that we would really appreciate you taking a moment to complete. And again, we do appreciate your time and your attention. We know it's valuable and we appreciate you spending it with us. So thanks to everybody. Have a super rest of the week and bye-bye for now.